Do you know how the banks fail? Bank failures are not uncommon. In this video, we will learn in details. Please hang on till the end. I am Sudham Ghosh, an ex-banker and faculty member, and now a global instructor. For full access to the complete course on bank failures, economic crisis, and Basel Steel Framework, you can log on to the link below. If you haven't subscribed to my channel, please subscribe, like, share, and provide your valuable comments. That will motivate me to bring more interesting videos for you. Now, let's start. We will learn how the banks have failed in the past. We will learn the consequences of bank failures. We will also learn how banks fail. At first, let's have a bird's eye view of bank failures since the last century. During the Great Depression, between 1929 to 1933, 9,000 banks failed. And in 1933 alone, 4,000 banks failed. Again, from just before Second World War till the midst of the war, 373 banks failed between 1934 to 1941. After the Second World War, the world financial markets became more regulated, which resulted in fewer bank failures. Yet, between 2008 to 2012, during the subprime crisis, 465 banks failed, which resulted in great recession across the globe. Interestingly, between 2009 to 2021, 511 banks failed, resulting in a cumulative loss of 74,839 billion US dollars. India too has a long history of bank failures. Between the First World War till the beginning of the Second World War, as many as 350 banks failed between 1913 to 1934. Again, from 1935 till the Indian independence in 1947, 900 banks failed. From 1947 till the bank nationalization in India in 1969, as many as 665 banks failed. Despite nationalization, private banks keep failing in spite of strong government regulation. But these failed private banks are generally taken over by a public sector bank in public interest. Let's now understand some important consequences of bank failures. First is loss of customer confidence. People park their funds with banks because they consider their funds to be safe, profitable, and very liquid. Bank failures destroys the public trust, thus causing depositors to shy away from banks. And then the capital formation capacity of the banks is destroyed. Banks are the primary intermediaries who mobilize public savings and convert them into investments. That leads to capital formation in the economy. Bank failures cuts the source of public funding, which eventually hits its lending capacity. Then you have the decline in funds for investments. Bank failures cause shortage of liquidity in banks, which force them to stop lending to businesses and other sectors. As a result, flow of investments to productive sectors dry up, leading to economic stagnation. Then you also have the negative multiplier effect. A fall in investment levels causes lower productive capacities, which affects the supply of goods and services. The prices go up, which dampens demand. Lower demand further cuts on investment levels by the firms, and the cycle enters a downward spiral. As a result, economic growth is affected. You also have a demand deficient unemployment. Due to lower demand, more and more industries employ less and less people and also reduce existing workforce. Rising unemployment further reduces market demand due to depleting incomes in the society. And also, there is a disruption in payment systems. Banks are the key payment gateways to individuals and firms. Disruption in payments chokes liquidity in the market, thereby causing demand and supply equilibrium. Then you have a cumulative effect which leads to monetary contraction. If the contagion spreads to other banks, there is a disruption in the economy which leads to an overall monetary contraction. If the situation persists, there is a threat of an economic crisis. Let's now understand how a bank fails. Although today's banking business model is very complex, but its sole business still remains the same. That is accepting deposits from the public, repayable on demand for the purpose of lending and investment. We will understand how banks fail through a very simple model. To start with, the depositors park their idle funds with banks because banks are considered as most trustworthy. Banks promise to pay regular interest and also repay the funds on demand. Banks also provide high liquidity, secrecy of transactions, and transparent dealings. The banks also provide deposit guarantee to the depositors in case it fails. So the funds move seamlessly in this cycle. The bank then lends a major portion of such funds to various borrowers who are short of capital funds and want to invest in new ideas. The banks provide loans at higher rate of interest against security of assets. The borrowers utilize the capital and expand their business. The borrowers repay the principal amount in installments in time along with regular interest out of its operating surplus. They also abide by other terms and conditions. Incidentally, the borrowers also transfer their own business risks to the bank. The bank undertakes the borrower's risk in the usual course of its business. Therefore, the funds from the depositors are profitably deployed with the borrowers. The difference between interest earned from the borrowers and the interest paid to the depositors is the net interest margin for the bank, which becomes its main source of revenue. The repayment of the principal loan amount and its interest component by the borrowers are successfully used to repay the depositors. And the business goes on in a cyclic manner until there is a break. But this model is very risky because every bank has certain amount of rolling risk, that is, not being able to roll over short-term liabilities. Moreover, the business risks from the borrowers are transferred to the bank's balance sheets. The business failure of the borrowers arising out of credit risk, market risk, and other risks affects the liquidity of the banks. Now, suppose the bank has created large amount of risky loans in different categories and a bulk of the borrowers fail to repay as per the contract. The failure to repay could be due to business failure, personal reasons, diversion of funds, or due to willful default. In that case, the loan turns bad and the likelihood of its recovery becomes very risky, and we call it non-performing asset or NPA. Now, if this NPA zone becomes more and more, the loss becomes unsustainable for the bank. Its interest earnings is affected and default of loan repayment affects its cash flows. The loss is eventually adjusted from its capital, and in due course, its capital is eroded to a large extent. The bank, of course, attaches the security of the borrower and sells them to recover its dues and also proceed against the borrower personally. If this continues for some time, the bank fails to repay the money of the depositors and the depositors' money is lost. As a result, the situation snowballs into a crisis. The bank faces an existential crisis and the depositors approach the court for liquidation of the bank. This is called bank failure. The bank failure happens due to lack of liquid assets, resulting in crystallization of the liquidity risk. The bank failure also happens due to lack of adequate capital, resulting in crystallization of the solvency risk. Now, this bank failure may happen as a stray incident at the micro level or may spread to other banks in the industry. We will understand bank failure through a bank balance sheet. Primarily, a bank failure happens due to balance sheet imbalance. At first, we will discuss bank run and then insolvency. A bank run happens when there is a liquidity crisis in banks, where the bank does not have enough liquid short-term assets to meet liquid short-term liabilities. An insolvency or bankruptcy happens when there is a capital erosion due to mounting bad debts or NPAs or even bank fraud. It results in a balance sheet imbalance where the bank owes more than it owns. Let's look at this balance sheet of a bank. On the liability side, you have deposits of 150 billion which are payable on demand and also short-term borrowings of 50 billion. Therefore, the bank has short-term liquid liabilities of 200 billion. On the asset side, the bank has short-term liquid assets of 70 billion, consisting of cash balance of 5 billion, reserves with central bank of the country of 35 billion, balance with banks and money at call and short notice of 15 billion, and short-term investments of 15 billion. In the normal course, the entire deposit base of 150 billion is never withdrawn by the depositors at a time. Only a portion of the deposit is withdrawn. Yet, the bank has short-term liquid assets of 70 billion to meet the demand of short-term liabilities of 200 billion in the normal course. But consider a situation where there is a rumor about the bank and all the depositors and short-term creditors want to withdraw their money. Clearly, the bank does not have enough short-term liquid assets to meet the entire demand. The bank falls short of short-term liquid assets and it faces deep trouble. At this stage, this ABC bank rushes to the money market, which is basically a club of solvent banks, to either borrow liquid funds or sell its assets at a discount. The purpose is to generate funds in order to pay the depositors and the creditors. But if the ABC bank fails to borrow liquid funds from the money market, then obviously it fails to meet its commitments. The bank loses its traditional trust among the depositors and the creditors, and a bank panic grips the market. This is when a bank run happens. More and more depositors rush to the bank to withdraw their entire money, and the creditors too demand their money back immediately, that is 200 billion at a time. Obviously, the bank fails to meet the demand. This is typically a bank failure caused due to liquidity crisis when short-term liquid assets are insufficient to meet short-term liabilities. Okay, now let's see how insolvency or bankruptcy happens. Here the bank has loans and advances of 140 billion created out of the depositors' money and its capital. The bank's share capital is 20 billion and the reserves and surplus is 10 billion. Therefore, the total capital of the bank is 30 billion, which belongs to the shareholders of the bank. Now, if the bank has aggressively created bulk of risky loans, then the loan book would be hit in the event of a market downturn. Suppose there is a market downturn and a large portion of the loan book, say 100 billion, turns bad. Because the borrowers would not be able to pay and it would be considered as loss assets or non-performing assets or NPA. So the loss would be 100 billion. Now, how would the bank adjust the loss? At this stage, the bank will adjust the loss from the capital and reserves of the bank because it belongs to the shareholders of the bank and they should absorb the losses. How it is done? Now, instead of 140 billion, the total loans and advances would be shown as 40 billion and the 100 billion of loss assets would be written off from the capital and the reserves. If we reduce the loans and advances to 40 billion, the total assets comes down to 165 billion. And if we wipe off the capital of 20 billion and reserves of 10 billion, the total liabilities comes down to 235 billion. As a result, the capital of the bank would be completely eroded. As you can see with this change, the assets come down to 165 billion and the liabilities come down to 235 billion. That is, the total assets become less than its total liabilities. In other words, the bank owes more than it owns. The loss can also be the result of a bank fraud where the loss wipes off the entire capital of the bank. In such a situation, the bank would stare at liquidation and this bank will cease to exist. The depositors and other creditors would then approach the court for liquidation of the bank. Okay?